They don't represent all
They
of
don't
us.
pay for you guys. It's fine.
Welcome everybody to
Sponsored
SoFi Weekly. Tanner, I'm trying to kick us off, all right? I'm going to start again.
Yeah.
Welcome everybody to the SoFi Weekly. Very exciting show for you guys this week because the Fed lowered interest rates. But first, I don't know how to continue. How do you guys feel? Oh, there we go. Chris is here to save my ass. Welcome, Chris. How's it going?
Good. Can you hear me or no?
Yeah, we can hear you perfectly.
Okay.
Let's start off. Yeah. How's everybody doing? I was gonna say let's effing go, boys and girls, ladies and gentlemen. But Come Rocket got to it first, so yeah.
Dude, it's crazy. Like, I've been making just videos on YouTube part-time for years now, and every time Tanner's like, all right, Tevis, you're kicking us off tonight, I still get like super nervous and don't know what to say and have stage fright. I don't know how you do the daily live streams, honestly. How
many episodes have we done on the SoFi Weekly? You've kept a good tally, right?
Yeah, we're I think like at 100 or so right now.
Is this our 100th episode? Is that what you're telling me?
I think we're at 96. But okay. I've also missed a couple, which I haven't done highlights for, so we might be over 100.
All right. There's a good chance this could be the 100th episode, maybe.
It could be the 100th episode.
Good chance, maybe.
Yeah. Chris, thank you for joining us.
Yeah, my pleasure.
Roy, how are you?
Doing good.
Yeah?
Glad to be here.
When do the lights come on in Roy's house?
They don't anymore.
SoFi has to get back to double digits and hold that, and then we will turn off dark mode. We'll turn on the lights again.
Dude,
until then, no, it's dark mode, Roy. Sorry.
Palantir's not doing enough for you.
You don't even know
the electric bill.
This isn't about finance. This isn't about finances. This is about memes.
You don't even live alone, man. Your family is like, Roy, turn on the lights. And you're like, no, SoFi has to hit a certain price.
So obviously, throughout the house, we have the lights on, but I love the dark. Like, this is actually where I was working out of when I was working from home for the university that I worked for. Different job now. So, but I would typically have it this dark, if not just a little bit darker. Yeah.
But rate cuts are in, ladies and gentlemen. How do you think Noto's feeling right about now?
Vindicated. He was asking for 50 too, so he got 50. I thought 50 was warranted, but I thought the Fed would give 25 just because it's the Fed, and so I was pleasantly surprised. I don't think that this. And the nice thing is, like, we saw the initial reaction from the market. Very excited, and then it kind of sold off that day, and then the next day, of course, is one of the best days to be in the market. It just kind of goes to show you it's just better to be in the market if you're in quality companies long term, because it's hard to predict that day by day movement. And I certainly didn't succeed in that. So, but certainly SoFi is a huge beneficiary of this, and Noto got exactly what he wanted. So look out.
And also stating that he wanted, 75 basis point cuts before starting 2025. So it's looking like we might actually get above that at about 100 basis points by the end of the year. Chris, do you think that that's what's going to happen?
I did listen to Powell after the fact on Wednesday. I think we're pretty much guaranteed at least 100 based on, like, again, if nothing changes, like if things continue to go the way they have been in the last, call it 5-6 months in the macro, where inflation kind of stays down and is kind of slowly trending down, and unemployment, if unemployment jumps, we'll get more than that. But the way it's been going, it's been rising up, right? And these things have hysteresis. So like if you start to go up, right, it's not like going to start going up and then all of a sudden it goes flat and goes straight, right? And so it's going to take at least a little while for unemployment to flatten out, which is what they're hoping for, right? To get to nail the soft landing. And so, but based on the comments that Powell made, like, he was as dovish as I think you could get, while still saying, hey, we're going to be data dependent and see what happens in the data. But the fact that they cut 50 to start, I think, was the right move. I was with Roy. I thought that they were going to do 25 because in the past they were very slow to react at first.
Same.
I think that in the press conference, he actually talked about, so one of the questions was, if you look back in the July meeting, if you would have had the the correct employment numbers and the correct jobs numbers, because they were downgraded so much, would you have cut? And he didn't say yes, but he kind of left it open to the fact that, like, if they had that data, they might have made a different decision at that point. And so I actually think that like, and that's what I thought at the time too. I was like, if they had this, I was leaning towards them. I think they should have cut 25 in July. And I think after getting that data, that most of them felt the same way. And that's probably why they cut 50 this time. That's just my read on it based on, listening to the press conferences and what I see, right? I'm no macro economist, but those are my thoughts.
Roy, you want me to share this?
Yeah, go ahead and throw that up. So there's 2 more Fed meetings between now and the end of the year. November, I guess I'll pull that up real quick just to show where things are at. Basically looking at possibly between a 25 and a 50 basis point cut is the probabilities right now. These shift around quite a bit. You can see how much change happens. Part of that was the rates, but it's basically a coin toss at this point that people are projecting 50 versus 25. And then looking at the end of the year, we can see where they're expecting rates to be. Right now, consensus is right around the 400 to 425. So that's giving Anthony Noto exactly what he was wanting. There's a chance
that would be
for
5 cuts total, right?
Well,
from the top.
I mean, it depends how you quantify them, right? 3 cuts, but technically 1.25 or 125 basis points from the top.
Yeah.
And
I guess 3. Yeah. I see what you're saying.
Lower here. So we'll see what happens. In a lot of time between now and then. The nice thing is, I think that since they did the 50 basis points, it gives them some flexibility so they can kind of look and see how things are progressing. If they need to do 50 and be a little more aggressive, they can. If they want to just take a step back and just do a 25, they can. And I don't think it's going to upset the market too much.
Yeah, so maybe let me just sort of present a slightly different take. I'm with you guys that the range is sort of between 75 to 125 bips, like bare base bull. With 2 meetings, to end up at a 75 would mean that one of the meetings they don't do anything. They just, pause, and then they cut 25 basis points the second meeting. And that's how we end up at 75. The base case is essentially 25-25 for the remaining 2 meetings, and we end up at 100. Or if there's 50 and 25, then we end up at 125 for the end of the year. I think barring any major macro, massive catalyst, the natural progression is somewhere within this range. I found it really interesting. I don't know if you guys had a chance to check it out. FedEx reported earnings, I think yesterday or the day before, and they were like drastically lower than people were expecting.
It was like Friday morning, wasn't it? Because Thursday was that really great day, and then on Friday everything was down.
That sounds about right. And FedEx is like, how does this relate to this? Is because, I mean, I saw this post on X where it was like this excerpt from a news clipping or whatever around Alan Greenspan using FedEx as a bellwether for the economy, essentially, to gauge the health of how many packages are being shipped, so on and so forth, to determine the strength of the underlying economy. And if a company like FedEx is massively missing their numbers, then obviously that's going to perk up some ears around, okay, how strong is that consumer at the end of the day, which could then lead to the Fed adjusting their decision. I mean, to Roy's point, more data is still needed to make that decision. But right now, the way that I'm seeing it is fairly in line with you guys to say, okay, the range is between 75 to 125, but it's not as, peaches and cream as the Fed is making it out to sound. Like, hey, we tackled inflation, double thumbs up. Now we're going to focus on the jobs numbers and the unemployment rate. And that's essentially like the playbook to a soft landing. Numbers like FedEx, whenever that comes out, it spooks, I think, the market a little bit because it could speak to the underlying consumer being weaker than was initially expected, which plays against that soft landing narrative.
And this is just FedEx stock price on screen, by the way. Yeah, I mean, I'd be interested to see more of their numbers because it could be a similar Ally sort of situation, Ally Financial, where it's one company's understanding of the market rather than the full industries. I don't know if Amazon, for example, has been taking more market share in the delivery of packages, and then that's maybe why they're talking down some of these numbers. But I didn't follow it too closely. I think that there's always more nuance there. Even like I saw Shopify was talking about how strong the consumer is, but then they were also in talking about how strong the consumer was, they were including market share gains, which is not good to do, because if you're really fast growing, then obviously the consumer's going to look great.
Yeah, I think that there's enough companies that have. We had this previous quarter of data. There's enough companies that are quality that noted just a little bit of weakness or softness, especially among the lower end. I think some companies that are not particularly well run. So Ally would be one of those. Dollar General, although maybe with the CEO back, they'll be okay. I think that they just saw that as an opportunity to really point the finger, not instead of at themselves, at elsewhere. But I think that there's a little bit of smoke there. It doesn't mean that things are burning or that a recession is particularly likely, even though a lot of indicators, a lot of macro people are like, yeah, recession's coming. And they've been saying that for 2.5, 3 years. Could happen, but probably going to be a mild one. And I really think that is a major recession, not a minor one, is the most realistic bear case remaining on SoFi. And even then, I think SoFi will be just fine because Noto is pretty conservative with its investment strategy. That's one of the reasons why lending was slower this year. So SoFi will be okay, just slower growth.
I do think actually that we kind of did. I'm not sure exactly how to say this. I think that we did in some ways have kind of a rolling recession. So like I work in my company manufactures like equipment, right? So for liquefied natural gas, other cryogenic applications, etc. And so we provide heat exchangers, compressors, tanks, valves, like an industrial equipment. And specifically in there was a huge downturn in the whole industry because of a lot of things, but inflation really hurt things because now everything, like all of the durable goods, so like steel and stainless steel and aluminum, the price of all the commodities went way up, which meant that, and then you had all the supply chain disruptions, like the lead times on some of the equipment that we order went from 20 weeks, which, when you're used to SaaS like Tevis, waiting 20 weeks for something sounds like an eternity. That's what they used to be. Now they're up to there's some pieces of equipment that we order that are 70 to 90 week lead times. So if you place a PO today, it's 2 years until you get that piece of equipment, right? Wow. And a lot of that, and so a lot of the industrial stuff kind of ground to a halt. SaaS also went down to all-time low multiples in the actual, it's recovered since then to a degree, right? But SaaS actually had a pretty big drop in terms of growth rate. There's lots of industries that and then obviously financials got hit in March, when because of the rising rates and commercial real estate and everything else. So it seems like in a lot of ways we've actually hit a lot of things that were indicative of the fact that the economy did slow down in a lot of different ways. And it has it seems like things have normalized a little bit, to me at least. And at least in my business, it's the same way, right? Things have in the industrial sector, people have kind of recalibrated their expectations for prices, their expectations for lead times. We're starting to get past our backlog, and so lead times aren't as long. It seems like there's been to me, it was kind of a rolling recession where different sectors got hit at different times, but overall the economy still kind of stayed strong. I don't know if you guys agree or disagree with that. You're welcome to disagree.
The problem, Chris, is that, and I don't know, I see parallels in my daily, sphere, let's say. 2022 was not a great year. We saw slowdowns in growth rate. 2023, similar, where we were raising money because just to plan for contingencies. And now the growth is coming back, but not to the strength where it was before. The thing that sort of gives me pause is the fact that the changes that the Fed is making right now won't be felt to the underlying consumer for such a long time. And so for consumers who are holding out, let's say, who are saying, okay, let me brace the storm, the tough time is going to pass, they're going to be waiting for longer than they probably expect to be waiting because of the lag in terms of rate cuts and how long they take to get to the end consumer. And so during that, limbo period is what I'm really worried about, because it might seem as though the Fed is doing everything right to be able to fix the economy and get us to that soft landing. And then things might break as that lag time goes on over the next couple of months, over the next couple of quarters, because by the time the consumer actually feels the rate cuts, it's going to be like, a year from now.
Did you guys see that SoFi is doing a reverse stock split?
No.
I know Chris did. So Chris, don't spoil it.
The ETF. Yeah.
Yeah.
Sorry.
SoFi, here, wait, I have it on my screen here. SoFi announced a reverse stock split for the SoFi Select 500 ETF. Can someone explain this to me? Why would this even need to be the case? Why would they advocate for this?
If you know the answer, tell me, because I have no idea. It doesn't make sense.
It's pretty low. Like the price of it, I think, is around the 20s. I own some. Like I just use it as my proxy for, like, for the S&P 500. I invest in that instead of like SPY or something like that, because as a SoFi member, their fees are right now they're at 0%. So like 0% is better than even you get through like VTI or VU or whatever. And so I own some, but the stock price is 20. I have to assume that they think that it'll increase the liquidity or increase the assets under management for some reason. If it's trading at, call it 100 or something, so it'll look more expensive. So it'll go from, it's a 5-to-1, right? So it'll go from like $20 a share to like $100 a share.
Yeah, it's a reverse stock split. It's not a stock split, so it'll look more expensive, which is interesting.
Yeah, I don't know why.
Tevis, is this the first time you're hearing about this?
It's the first time I'm hearing about this. I'm trying to understand the logic. So I think like where my mind is going, again, this is silly, but so on one hand, the first thing that pops into my mind is their whole mission is to essentially, democratize finance, help the little guy, whatnot. And so it's a smaller stock price for an ETF like that would be more beneficial, because if I have $20, I can still, but then they probably have fractional, so it doesn't really matter. I wonder if it's anything to do with like management fees or anything to do with like the amount of shares outstanding, like the float overall from like a liquidity perspective, or like something technical is where my mind is going as to why they would do this. I don't know if it would be like customer facing motivation, like from a marketing perspective or whatnot.
I don't think there'd be shares outstanding. I think it's an open fund. So for every share that you buy, no, never mind. Yes, it is an open fund. So for every share that you buy, they create a share for you, because the price is not based on how many people are buying it. It's based off the index that they're following. So it's an open fund. So if you sell your shares, those shares get tossed into the void.
How do they make money on that? Like, let's say I go through that ETF. How do they make money? Like, how does that management fee work?
Well, they would just charge it as a fee over time.
On what?
So on an annual basis.
Yeah, but
on the amount that you own. So if you own, call it
Yeah.
$100 worth of the stock, and it was, you had a 1%
like
management
0.5%.
fee, right?
And I can buy fractional.
You can buy fractional shares too.
Okay.
Yeah, just 0.5. I think it's 0.5 or 0.59, something like that.
Right now it's 0. I mean that's one of the things that Noto actually
I think
talked
that's
about in the Goldman Sachs
SoFi
conference.
Plus users, right?
I think it's actually for everyone right now.
If I remember correctly, they've been rolling a lot of that back.
It's possible they might have. I could be wrong. Okay, it looks like the gross expense ratio is 0.19, and then
0.19. That's extremely low.
It's very, very low.
Is there any like, and this might be a stupid question, but is there any delisting risks for ETFs at some lower threshold? Like, I don't think $20 is any threat. Like, I know if you go like under $5 or whatever, you're technically in like penny stock land, or you can go OTC. But I wonder how it might work, because I'm just trying to figure out in my mind why they would even do it.
No, even SFY is their largest fund, I'm pretty sure, or over $1 billion.
I'm pretty sure it is, yeah.
I think they have over $1 billion in that fund. I can't imagine anything along those lines. It is very weird. It's very weird, but also I also don't think it has a negative effect either, right? Like, other than the fact of maybe it stops newer investors from getting in, but I'm sure, like what you said, it might lower their management cost. Maybe they're paying based on the amount of shares that are flowing through the system. On the actual administrative side, I've got no background at all.
From the consumer side, if they're getting fractional shares, it can be $100,000 a share, and it doesn't really matter for people. It's just a perception thing at that point.
Yeah, and honestly, I think as I've always had this take, but as fractional shares get more and more common, I think the tokenization of securities is going to happen, and then there won't be a share price. Like, even the idea that some of these tokens even have a price makes no sense, because the only thing that you should be basing it on is market cap, considering you can have $1, $1,000, $10,000, and it doesn't change the fees or anything. I think that shares will go away.
If I had $1 for every time somebody correlates price to market cap or size of company,
I know.
You know, like, it's insane. Oh, well, how is Tesla, 100 times bigger than Ford? Like, it's just insane.
Isn't it actually 100 times bigger than Ford by market cap too?
That's a bad example. Okay.
I have the same example every time. I show people Apple, and then I show people Berkshire Hathaway Class A shares. And I'm like, which company do you think is bigger? But it's a very complicated thing. It makes no sense, especially, well, I mean, it made sense in its time. It doesn't make sense going into the world that we're going into. But yeah, what other news was there on the PayPal side? I've got some, on SoFi side, I've got some PayPal news. I've got some new bank stuff, but on SoFi.
Come on. I was like, all right, PayPal already? Like, let's go.
Yeah. Do we want to talk about the ramifications of cuts for SoFi?
Yeah, we need to, like, why they're actually bullish, why they're meaningful. That it's a good reminder.
Anything, Tevis, on SoFi? Sorry.
What? Oh, the ramifications of cuts?
Yeah. Like, why is it actually bullish that they're cutting for SoFi? Just as
sorry, I missed that. My apologies.
Yeah. Do you want me to start?
Yep.
So, made a couple of video. I mean, we've talked about this in previous SoFi weeklies as we were getting closer to the cuts. My whole thing is that it's duly beneficial. From one side, you have why it's beneficial for the stock, and in that it's because SoFi is seen as like a risk on, high growth, low market cap company, and the entire market as a whole is going to get a premium essentially as rates fall. What you get from treasuries is going to fall, so more money is going to flow into equities, and there's going to be essentially more buyers, and that's going to drive the price up. My whole thing is that there's going to be a premium towards low float or low market cap companies, because the mega caps are essentially the safe havens. When you're going through a 2022, for example, Apple will generally fall less than SoFi will fall. And so a lot of people hide out there. But when you're going into risk on times where equities rise, then lower market cap companies have a higher runway for growth. And so on the one hand, just from a stock perspective, the entire market is going to get a boost because of the money on the sidelines that are flowing in. And I think SoFi can have, along with many, low market cap names, can have a premium to that, because the market is going to go more risk on. Investors are going to be looking for a rate of return. And then on the SoFi specific side, it helps from originations perspective with student loans and home loans respectively. And that's in the entirety of SoFi's business that they've sort of been building in the background with the acquisition of Wyndham, with now the moratorium being over. I think that's really going to help accelerate SoFi's growth rate, accelerate their financial situation in general, accelerate how much money trickles down to the actual bottom line, and it's going to make them look much better from a valuation perspective if they don't if their stock price stays relatively the same. So We're going to see, but that's essentially the thesis. I don't know,
Travis,
Chris, you have probably a much more eloquent way of saying it. What?
their most popular financial services product right now, SoFi Money, is going to have a hard time during this time with their interest income lowering if rates come down. What is SoFi going to do? And anyone can answer that.
I think that's
Yeah,
a red herring.
it's like the easiest softball ever. Like rate cuts or rates, interest rates are not the only reason why people choose a bank. There's a lot of reasons. Frankly, as someone that switched from Wells Fargo to SoFi, 9-day different experience. I'm not at SoFi for the interest rate, although it's quite nice. It's because Wells Fargo is garbage and I loathe them. We still do have a small account, by the way, so please don't freeze or lock up or do whatever you're going to do to me. But they're terrible. Versus SoFi, like it's a really good bank, really good experience, and there's a lot of benefits for being a SoFi customer. That flywheel is it's very nice, very lovely. It's just so much easier. Like they actually live up to their motto of "get your money right" versus Wells Fargo is "get all the money you can from this sucker."
I meant even past their. I mean, they can control their interest rates. People can leave or stay, but they may make less, especially on the revenue side for sure. But I think what Chris said, it's a red herring, is still going to
Yeah, I mean,
be the case.
it's all about the spread, right? Like that's the difference. It's what they charge or what the revenue, right, is the difference between what they give out to their members and what they charge the lending segment or what the lending segment lends from them at, right? There's some sort of spread in there. And I don't know if, I mean, Noto did say that, like, they've said that they want to keep it higher for longer. We'll see how much they actually do. They haven't cut yet, despite the fact that, the Fed cut 50 bips.
Well, they did cut. They were early to the cut.
10 early. But 10 is not very much, right? Like when they were going up, their beta was probably somewhere around 0.7 or 0.8, which means that like when the Fed went up, call it, 1%, then SoFi would go up 0.7 or 0.8%, right? That's what people call the beta. And so on the way down, so far their beta is 20%. But I would expect them to probably cut sometime, like cut the APY in the next couple of weeks. If they don't, that'd be really interesting. But I don't think that the other thing is that like the loans that they currently have on the book that they're going to keep, it's not like the ones that they already have, the 20 odd million, amount of loans on the book, those aren't going to just drop off immediately. And so most banks, as rates come down, they can lower their APY faster than their book runs off. And so SoFi has this existing book that's at, call it 13% for personal loans. And the student loan APRs are actually higher now than they were, than the book is. So that the student loan APRs are going to continue to go to expand, not to contract. I actually think that net interest margins probably, like overall net interest margin, which is what you actually care about, right? How much you allocate to the lending segment versus how much you allocate to the financial services segment doesn't matter that much to me. Like it's either going to go to one place or the other. But the overall net interest margin, so the amount they make, I think will expand further, not only because they're going to lower cost capital, but also because that existing book is going to stay high. I also think, so on the way up, so as rates were going up, there was this weird phenomenon for SoFi where SoFi was able to expand their net interest margin on the products, or at least keep level with their rising cost of capital. That's not what other lenders saw. So specifically, Lending Club is the one that I'm talking about. So Lending Club in their personal loans, like their net interest margin dropped a ton during that same time. And their CEO, who he's a good CEO, and he explained it. He said that essentially what happens for them is that the Fed will move their rate up, like call it 4.5% to 5%. And then a month or so later, credit cards will follow. So credit cards would go from, say, 22% to 22.75%. And only once people saw their credit card rate going up would Lending Club then be able to move their rates up. And so he basically said that there was like a 3 or 4 month lag between the Fed moving rates and Lending Club being able to move its personal loans. But SoFi actually did the opposite. So SoFi's personal loans went up faster than the Fed funds rate.
Right.
Like the amount that they were getting in. And I think that the reason why is because this is the only explanation that makes sense to me, is the fact that SoFi was able to, so they've got a ton of members that are coming on board every single quarter, and all of those members that are coming on board expands the pool of borrowers that are applying for loans for SoFi. And that's very different from, like, there's no other bank that's growing their members at 40% year over year. And so if you're expanding your pool of borrowers by 40%, you can raise your rates faster and still get as many originations. And so I do think that on the way back down, that the APRs that SoFi is going to, like, I think that they can stay high on originations and keep the amounts that they're charging on their loans higher, because we're still, SoFi's member count is even expanding faster now than it was back then. So this was back when you were getting, call it 400,000, members a quarter. Now we're probably at the level where I don't think anybody on this, 500,000 is the bare minimum. I think everybody probably on this SoFi Weekly thinks they're getting at least 600,000 every single quarter from here for the foreseeable future. So they're growing it, 50% faster than they were back then when they were able to do that. So I don't know. I think that net interest margins are going to expand, but we'll see.
I got a question about the gain on sale margin, because obviously I've not been following too many financial stocks before SoFi. One thing that's very interesting to me is the gain on sale margin kind of disappeared as rates were climbing, which is extremely hard for them to sell loans, because the risk-free rate is always going to perpetually get better, but their existing loans will get worse over time. But in a rate dropping environment, it's flipped. Do you have expectations for where this gain on sale margin on their personal loan side, for example, is going to go? Like, how high can this get? What was it historically back whenever rates were at 0%?
So thanks for teeing me up.
No problem.
So if you can, I'm sharing my screen. Is it being shared? I can't tell because I'm on.
It is, yeah.
Okay. All right.
So I don't know if you can zoom in more though, because it looks like a picture in a picture.
There you go.
Perfect.
So this is personal loan gain on sale margin. So I guess for anybody who doesn't know what this means, so gain on sale margin means, like, if you have $100 of loans, if I'm SoFi and I have $100 of loans from somebody and I sell them to somebody else who's buying the loans for me, the gain on sale margin is the amount above principal that I'm selling them for. So if I have $100 and I sell it at 4% gain on sale margin, that means I sold it for $104. And so you can kind of see at the bottom. So this is during the time. So, second quarter 2022 is when we started getting rate cuts in earnest. And so the gain on sale margin was right around 4%, call it 4.5%. And then once rates paused, and now going into, the future, the gain on sale margin has actually gone up quite a bit, as you can see here. So it's up at around 6%, which is really, really high. And so SoFi does hedge their loans, which means that, like, they try to buy hedges to make sure that, like, if rates go up or if rates go down, they can still get the same amount. But but you're still at the whims of the demand, right? And so it appears to me, like, the way that this graph looks to me is, as rates have flattened and as the forward curve has come down, because, like, the bond markets have already priced in a bunch of drops, right? The 10 years way down from its high, the 2 years way down from its high. And so as the forward curve has moved downward, it seems like there's a lot more demand coming into the marketplace, and that's why they're able to command higher gain on sale margin. Now, I don't know where these numbers could go, right? But this is a positive trend that I'm happy about. And then student loans. So student loans kind of saw the other. They're here somewhere. Let me see if I can find them. Student loans, they haven't sold that many, but they've been pretty much flat at 4%, like, forever. But you can see there's a bunch of quarters that got skipped in here, right? So they sold absolutely no student loans in third quarter, fourth quarter, first quarter of, like, 22, 23. And then there was another big gap until the last quarter as well. And so, like, they haven't sold as many of those. I hope that they start originating those and selling them more, because they have a lower net interest. You get lower interest on student loans than you do
Right.
on personal loans, right?
So there isn't some sort of benchmark or any data that we know of where we could get to 108, 110 on
If they
personal loans.
stopped hedging their loans, like if they had stopped hedging their loans, call it in October, right, when the 10-year was at 5%, you could probably easily get up that high because you'd be getting these huge headwind or tailwinds from rates coming down. But having like in one of the calls that I had with Chris LaPointe at one point, I said, "Are you gonna if it's obvious that rates are coming down, would you choose to not hedge your loans?" He said, "No, we're going to, because we don't want to depend on the macro and we don't want to try to predict the macro. And so we will keep our hedges on no matter what," is kind of what he told me. And which is, again, the smart thing, because if you get a black swan or something, you don't want it to kill your entire company. And so I don't think we're going to get up to 108 or 8% or 10% or whatever it is. I maybe, but I don't think so.
Okay, interesting. Roy, Tevis, anything to add on this?
They can hold on. I know that there's a restriction with regards to originations, but I'm cloudy on it. Like, how long can they realistically hold on before they have to sell? Can't they just hold to maturity if it's
they don't. There's no restriction anymore because of the bank charter.
Yep.
Right. They don't have any obligation to sell those like they can just hold them to maturity if there's not a lucrative enough to gain on sale.
Yeah, no, they can, if it makes more sense financially to do that. The key though is not the key. The reason that you do want them to sell them is because then you can cycle the book faster. So then you can grow originations, right? So you could get up to, if you right now, SoFi sold about 1.2 billion loans like the last 2 quarters in a row, maybe 3 quarters. The last 3 quarters in a row. And so if they could, if next quarter they could sell $4 billion of loans, theoretically, instead of originating, call it, about 4 billion, they could originate 7 billion and they could just sell them on right away and make a bunch of money just in non-interest income on those sold loans. Now they're not going to do that, right? Because they're not going to expand their credit box that quickly in this environment. But
Matt Flow's in the chat now. Matt, check your DMs. I just sent you an invite if you'd like to join in. Sorry, go ahead.
No, you're good. How I've kind of always thought about it is that I think that SoFi, they want to have a minimum amount that they hold, and that's going to be growing over time as they're more profitable because they have more capital, so they can originate and hold more. But then the amount that they can sell on top of that, on top of their loan book that they hold, that's just kind of gravy because that's a bunch of non-interest income that they can bring in because they have this huge pool of expanded borrowers. They can just originate them and then sell them on to somebody else to make the interest on them.
Yeah, and because it's surprising that as rates were increasing so much that SoFi could find buyers for those loans. They're not going to run into a problem as rates are dropping. I don't think they'll have any problem selling their loans.
Yeah,
completely agree.
They can sell all that they want. I don't know that they want to sell many right now, just because, like Chris said, I don't think they'll be originating a vast sums of loans, although they could in the current environment. But they can just hold on to what they have, sell a little bit here and there. But they're not capital constrained at all, so they're not in a position where basically they have a lot of options. So it's a good position to be in.
I think it's time to go. I think back to what Dan Dolev said in that call that I had with him, where he said, we've always seen problems in the supply for loans. We've never seen a problem in the demand for loans. And I think they should run off their book, sell a ton and re-originate and go back to what SoFi was before the bank charter. They used to run through their book a ton. And in a rate dropping environment, it just seems like they would get the best bang for their buck on selling the book. And, you're opening yourself up to good student loans. Home loans are coming back and personal loans are still going to be there because credit card rates are still extremely high. So I don't know. Maybe I'm crazy.
You think that would you advocate for selling more than they originate in a quarter?
That's hard to say because I think that the capital ratio is very healthy right now. I would have said that back whenever it was at 14%. But also they said like in their call, they said we're going to end the year above a 16% capital ratio. I don't think they're going to hold to that anymore. So potentially they would be originating more than they'll be selling. So no.
Okay. Just checking. Just trying to understand, I guess, what you were saying more than anything else.
No, I just think I think that they need to originate a heck load more and sell a lot more. They can do both, but the ratio doesn't need to change. They just can bump up all the numbers.
One of the so while we're on the subject, one of the interesting things that Noto said at the Goldman Sachs conference, the one that was it 2 weeks ago? I don't know the timeline. Anyway, in the last several weeks, he talked about how they're going to basically be originating to sell almost immediately, which is more similar to what Lending Club does. So Lending Club will like they have a marketplace where they sell loans. And so I think it'll be interesting to see if they did how much of that they did this quarter, if they did any at all, because that would be essentially what you're saying. So rather than even holding them for any amount of time, they just originate, sell immediately, and just collect the gain on sale margin.
Yeah.
Hey man,
no, I'm a big fan of that. Maybe I'm wrong. Maybe I don't know the repercussions of that, but to my understanding, that was SoFi before the bank charter for the most part. Ladies and gentlemen, Matt Flo.
Hey guys, what are we talking about tonight?
Mostly SoFi for the most part.
Okay. I was watching.
No, we're going to be talking about you.
Buffaloes, so what's that?
We're going to be talking about you. Are you able to talk about who you are and what potentially you do?
I'm retired from a few different backgrounds, airlines and finance. I do a few things on the side. I do have access to the SoFi headquarters on occasion, and they have a team of us who look at the future products. They ask us about different things, and they tell us what direction they're going. There's a few things coming out that I've had direct access with, where we're broken into teams with the IT departments, and we tell them what sucks, which is a lot, and then they go ahead and put those on their boards to try and fix them.
Got you. So what products have you, if you're able to say, been testing that have really surprised you on the positive side?
Right now there's just a couple of new things coming out, and they're really working on adding products for financial education, which we appreciate. But there's a few of us, we really get into. So the head of Invest, he catches quite a bit of crap from us, and they know they have to do a lot of work there. So we've been working on that a lot. Even something just as simple as transfers. So this last week I was in, we were working on, it takes 7 clicks to transfer from your savings to your checking. And we wanted to get that down to 2. And so we were working on how we can get that done, where we can add new buttons, new items to kind of just to work on making the platform work more smoothly.
Matt, I thought I saw somewhere that you had the beta for Cash Coach. How should we be thinking about this? Is this like, one of those education features that's going to end up being a nothing burger from the wider, what brings money in? Or does it have some type of, is it a piece in a wider vision? Because when Anthony Noto was talking about it in the Goldman Sachs thing, he was talking about the whole concept of products on top of products. And to me, it sounded more like a feature, but curious to get your take on after having used it for a while.
Well, the funny thing when you say cash coach, even everybody in the office still calls relay. And cash coach is more of an AI product. It's not as simple as everyone thinks. It's not an if then type product. It looks at every account that you hook to relay. It looks at your spending patterns. It looks at so when you open your vaults, you can set goals. And what we were talking about a couple weeks ago was we're going to add some features to the vaults so you can say, I want to go to, and in this case, they said, I want to go to Bali. Well, how much does that cost and when are you going to go? And then you put in those parameters. Then Cash Coach will say at the end of the month, it'll say you have $1,800 left. So we suggest that you put 1,000. It'll break it out into $1,000 into your emergency fund. You need to put 600 into your Bally account, and then you need to pay down this credit card with the remaining 200. So it looks at the whole relay experience, and it will figure out percentage rates on cards, the goals that you have set, and where you want to be, and then it will make suggestions on that discretionary income that's left over at the end of the month.
So with the whole, so I didn't know the AI piece, and I think that AI piece is really crucial to understanding the impact of this thing. To me, it sounds as though this could be the core of a wider shift in terms of how people leverage SoFi's technology. Like if I have an AI that's continuously training on my data, my goals, my, what I want to achieve, what my income is, what my expenses are, extrapolate that over time, multiply that by the entire user base, then you can come out with something that's really powerful that can totally change the dynamic for how people interact with their financial institution. Like, is that on the radar? Is that the long-term sort of, vision, or we're just not there yet? This is just something we're playing around with.
Oh no, absolutely. That's their vision. And so this is one of their big products that they're really looking forward to, because back when SoFi was just doing student loans, the first thing they came out with was Relay, and it's like, why would they do that? And that kind of was a precursor to the direction that they wanted to go. So Cash Coach is something where they will look at your whole picture, but then you can say, well, I had $1,800 extra, and it was a little bit extra this month, so you can go back in, you can adjust that. So and then they give you the best suggestions for that. So it's really kind of like calling a friend or mom or dad or a financial advisor or whoever it may be, where the everyday person can get suggestions for what they should be doing for this money. And it's really important to their future goals, because of how they want the person to really experience SoFi. Hey mom, hey dad, hey friend, well, how what should I do with this extra money? And that AI portion of it really keeps them tied. I think it's a huge direction in the way that they want to go.
Can I ask, not potentially how you got involved in this, but why you got involved in this? Why you're trying to help SoFi along its journey? What's the meaning here?
For me, it was actually kind of interesting. I started investing in SoFi I think it was at $14. And I was watching CNBC, and Guy Adami said, if you liked SoFi at 24, you're going to love it at 15. And just on a whim, I bought some stock at about $14 via Guy Adami. And the reason I had done that was I just bought a property that I was going to build a house on in Lake Tahoe for $375,000. So I put another $375,000 into SoFi to double it. The stock quickly went to 24, and that was the last tip on those 3 tips, and I was being greedy. I was like, nope, I'm not at double. I want to make all my money back, and it never saw 24 again. So as it started coming down, I started to study what I had actually done.
Classic.
Yes, and I'm just being honest. And so, okay, what is this company that, I just made $275,000 and now it's at $10, and so I'm underwater. And I started to study this company, and just like you guys, it just got better and better. So I fell in love with the company. I started moving my accounts to SoFi as the stock was dropping. So I moved a Roth, I moved an IRA, and then I started moving investments over. At one point I had moved about, I don't know, maybe say $1 million into a vest. And I get this phone call from SoFi, and it's the invest group, and they want to know what they can do to make it better. And I started giving them some things that, I wanted, and they continued to push back and say they couldn't do it, but it was always on the list. But anyway, it kept dropping. I kept buying more, and the invest people called me back and said, we have this board of directors that you can join. And they recommended it. They said there's about 10,000 people that have applied, and we take about 12. And I applied to that, interviewed, and I was put on that board. And out of the 12, I'm probably the 11th dumbest. I mean, these are really smart people, really smart. They never pick me when we do breakouts into like groups of 3. So it's always guys your age with knowledge. All 4 of you right there could be on the board, and, they would be asking you questions over me. But I was lucky enough to get on there, and I just kept buying all the way down to the 6s, 5s, 4s. So, my cost average isn't that great. It's, maybe 775, 780. But I still have about just over 508,000 shares.
Well, he's retired, ladies and gentlemen. And he's green. That's the most important part.
Yeah.
I was going to say slightly higher average than me, but also slightly higher share count. So it equals out in the end.
But I was that guy. I mean, all the way back, when it was going up and down, I hopped into it without any background at all. And then once I realized, what was going on, I needed to kind of take a step back and start looking at the company. And that's when I fell in love with it.
So Matt, I have a million questions, but it sounds like you've mentioned invest twice now.
Mm-hmm.
Just from a technology aspect, innovation, I know we've sort of critiqued the technology aspect of SoFi, continuously in terms of the rate of new releases, because we compare it with Galileo, who's releasing products left, right, and center.
Mm-hmm.
What do you sort of make of that? Like, after seeing it from the inside, in terms of their appetite for risk, in terms of their appetite for new ideas, in terms of, how innovative these ideas are, and also the pace of execution internally. Like, is there just a whole number of products that they've tested internally and said, okay, this isn't going to work, and moved on to other ideas? Is there a whole number of irons in the fire that we just don't have access to because we're looking from the outside in? Or is it simply that, they're focused on a few core things and doing those core things well, and things just take time and we have to wait for them?
Yeah, that's a lot to pack in there. So I would say there's hundreds of irons in the fire. So for example, in one day, we might do breakouts and come up with 12 ideas, and then we pitch those ideas, and then out of those 12, one will be chosen, and then it goes back to people way above my pay grade, and then they look at that one, and you do that day after day after day. So if it's 12 different things a day, and then at the end of the week they have 7, and then they pick one. But quite frankly, just this is something I'm just guessing on, but they're trying to do what they can within a parameter of not just bringing on a ton of IT, not just just getting bloated in expenses and people, and getting more space. Space is an issue as well, but so there's tons of ideas out there, but they're just lining them up, and so there's decades of ideas that are just lined up, and they're not going to just start throwing stuff out there like other companies do. If there's if you could call it a fault, the biggest fault with SoFi is they analyze the product to death, and they make sure that it's perfect, and they make sure that this is something they want to put out there, and then they do that. So they look around where we are, and I think everyone wants this invest stuff, and they get very frustrated. There's another guy, hey Chris, I don't know if not you Chris, but the other Chris that's on my team, he watches too, and it's like, and Chris is a big advocate with the invest stuff, but they're more interested in getting this AI thing with the cash coach thing right. That's the direction that they want to go, and it's like you need to understand that is the way they're going to go. When they say get your money right, they're not changing it to we want to beat Robinhood, and we talk about Robinhood a lot down there. And some of those people are just not people that they want. Some of the people are, but their focus is really more on coaching the general public, the John Q and Jane Qs.
Do you?
They just find that much more important.
Do you guys talk about the exact demographic that you guys are looking at, or is it getting so broad now?
I don't, they don't really talk about an exact demographic because there's so many people out there that don't know what they need.
Sure.
So why would we focus on, you're going to do a focus group on, females between the ages of 24 and 27. It could be, the group that I'm in, it is a very diverse group. It's a very diverse company, and it's from, retirees to people that just got out of college, and they want to know about everybody and everything in between. And I really feel like they don't, you don't have to be 24 to know nothing about money. You can be 45, you can be 55. And so the education part, I've never had a conversation with Noto other than, can I have your picture? And here I thought I could get him on Tanner's
Show.
channel. So last time I was down there, I was like, oh shit, that's not gonna happen. he has so many handlers around him and so many assistants and all that I couldn't get to it. But it's my own personal vibe that that he has no interest in say these Robinhood fanatics that are day trading and throwing money into crypto for a couple of days. They have no interest in that. They are looking for the individual, regardless of age, race, whatever. Any person that wants to I hate to say it, get their money right. That
Are they just
cool.
looking out for the individual, or are they also looking out for the small business? Is there any insight?
Well, two things. So we get on them quite a bit. I think the next thing is that they're working on is there's if you have a credit card right now and you add your spouse onto that credit card, your spouse can't even see what's going on the other side. So right now the joint accounts, that's probably the next step. We're working on some of that, and getting the joint accounts going. They didn't really talk a lot about the business side. I know it's important,
And they might have their own focus group of small businesses that they're asking questions about. So who knows?
You're right. I think you're right. Yeah.
So
yeah, I wasn't
could I ask
privy to any of that.
quick question? So I think one of the downfalls of surveys is that people don't always know what they want. Like they'll say they want something, and then when they actually they don't actually know until they have the option. Is there any sort of one of my other bigger holdings is Duolingo, and they are consistently A/B testing everything in the app all the time, and so that they can then optimize and get to the point where then they see what the actual users do rather than what they say they're going to do. And I've gotten countless surveys from SoFi, but is there any, have they looked at all at doing kind of A/B testing on different products and different age groups, that sort of thing? Is there any sort of how malleable is it from that standpoint, or is it still kind of that same, they want to get it really right before they push it out?
Well, when you talk about servers, I think the way SoFi does it is they actually interview people kind of like what they did with me, and they have different groups. Now mine is more of a member board, but I know that they have other groups, and so they bring people in and they give them the beta and they let them play with it, and they bring the engineers right in with them, and they go through all of these potential products. So they're not just sending something out and saying, hey, Roy, what do you, if you can answer these 4 questions, what do you think of this? They're having people they'll either send it to you, they will fly you in, they will have all of these groups, and you talk amongst yourselves, and the engineers come right in, and you put together big boards of everything that you see that, and I've been in groups with 60-year-old grandmas from inner city Chicago, and lots of hip dudes and gals from New York, and they just try and run the gamut of this. But you call it a focus group, they really focus on that group. They're not going to go with the shotgun approach and just ask you 10 questions, because when they send something out, it's always somebody who has a problem with something, who makes the suggestion. So they want to get their target audience, and they want to whittle it down to people who can speak to it. And so they do a lot of it. I guess you'd say more internal.
Okay.
Matt, I wanted
Does
to
that make
ask.
sense? Does that make sense, Chris? Or is that
Yeah, it
what-
makes sense.
Yeah.
I wanted to ask Matt, just because you brought it up on trying to get Noto on Tanner's pod. I mean, this.
Did you also ask him if he can come on mine?
No. Just this segment has been like probably one of the most, if not the most insightful. I don't know. I geek out on the tech aspect and the testing aspect, and so I don't think you've disclosed anything that you weren't allowed to disclose. It's just how the sausage is made, essentially. What do you think? Just your opinion, your gut. Like, where do you think that reluctance comes from? From management side to interact with retail. I mean, Tanner just had Vlad on his show like weeks ago, right? And he's talked about product. He's talked about their approach to testing. He's talked about stuff that makes them excited, the vision, whatnot. And we sort of have to get that piecemeal from CNBC or Bloomberg or any of these. Like, is it some compliance? Is it some regulatory thing, do you think, or is it some other I'm just curious to get your thoughts.
And it's my understanding, like Scotia said, they are aware of the SoFi Weekly, correct?
Absolutely. Yep. They know all your names. Yeah. They know all of you. So to I guess to answer the question, I'm trying to think of how to put this, but I don't think people understand how big SoFi is and how important Anthony Noto is. And it's like they're so busy, and he has so many people lined up outside his office, person after person. His day, his month, his week, his year is booked. Like he doesn't have time. This is more I kind of put it in the camp of, does Tanner think that he's going to get Jamie Dimon on his show? Because that's where Mr. Noto is coming from. Like, this is not Vlad. This is not a toy. He's, Vlad was kind of the, he engineered and worked on a lot of that stuff. Mr. Noto was brought in to build this company, and as he said, to be a top 10 institution. It's not a joke. And he's so busy with everything else. There's just no way, something like this would be put on a calendar. If you go get Jamie Dimon instead, go get Brian Moynihan. They got shit to do. And, but at the same time, they do. I mean, we've brought it up, especially my buddy Chris, who's on the board too. We've brought up all the names, and they know the names.
Yeah.
So just the fact that they're aware of you guys, and fully aware. There's a whole department that that knows about you guys, and so don't be sad if he doesn't. You
hear that, guys?
If he doesn't have time for you, but you are known.
What's funny is Robinhood is having a summit, and I'm like, I'm going, and I'm like, no one's even gonna know me. If SoFi did a summit, I'd actually feel welcomed. I'd be like, I've made a weekly show about you guys. I'm sure there would at least be a handshake.
100%. I mean, it would be great, to get you guys into the office. It'd be hilarious because everyone would probably, they would know more about you than you would know about them. And, so so you guys are known, but it's serious down there. You know, when you go into the offices, it's you know, they're eating their lunch at their computers, and you know, they come in early and they stay late, and they work hard. And there's no ping pong tables, there's no pool tables. It's a very nice office, but they're working hard. So
Wow.
yeah.
Yeah, no.
So I've actually been recognized twice by SoFi employees because we've got Galileo's like 45 minutes up the road, and like randomly twice people have been like, "Hey, I know you," and I'm like, "That's weird." Anyway, sorry, man, I cut you off.
No, that's awesome. That's awesome. It's yeah, I could pick you out of a group of 1 million in a mall. So yeah, so you guys are definitely known.
Roy, you were going to say something?
I was just going to say, I know culture is one of those things that's really sometimes hard to get a lens on. And so just you sharing that, just
Exactly.
So appreciate that.
Yeah, this is invaluable. And we're a little over time, but I hope you have time at another episode to come back, because I'd like to gauge sort of your understanding of the different products and whether or not, like, we barely spoke about lending. Like, do you guys have conversations about personal loans or credit cards or these sort of things, and how those products might benefit certain users?
Well, credit cards, yeah, credit cards are on the front. But the other stuff, so
it's financial services that you're covering.
Yeah, and you know, mostly like the lending, I don't want to say autopilot, but the lending, they have, you know, the mortgages are set up. They don't have any more questions about that. Personal loans, student loans. So those are just a machine. It's, you know, it's people way up the board deciding, you know, adjusting rates a little bit, and the sales and all that. So, you know, I would say the lending is just automatic. That's, you know, that's the heart of SoFi, and they don't have any questions about that. They don't need to ask anybody how to make a student loan.
Right.
You know, it's just they're going to adjust their rates. They're going to make their sales. They're going to, you know, contact. And that's another thing, is that, you know, once you have a good contact, when they make their sales, they're not just going to sell willy-nilly. So they're, you know, once they have those clients, those are the first ones that they go to. So
can you settle a bet for us? There was some conversation about the SoFi Plus subscription product. Do you have any insight on this?
not a little bit. What's your question?
Is it a new product, or is it just for non-direct deposit users?
It's a little bit of both, actually. So it's because they're gonna the SoFi Plus is gonna come out along with some different credit cards, and so they're gonna make a little bit of a shift in products, but yeah, pretty much it's gonna be a a subscription. You know, if you don't have, but they're looking at, you know, if you don't have your direct deposit, you can pay this, or you can deposit X amount per month. And then they've looked at having 3 different tiers, is all I know, is what we're discussing.
And do you know any of these prices, or no?
No.
Okay. All right. Anything else, guys? Tevis, I'm sure you're the product guy.
Dude, I'm buzzing, but Matt, you have to come back on, because I have a million more questions.
Oh, I don't know if I have any more answers. I think I've given you everything. We'll see.
Thank you so much, my friend.
Hold on, Matt. Let me ask you this. Do you think that we can also do this off camera too, but do you think that as people at SoFi see this episode air, you know, Monday or tomorrow, or maybe they're watching live, how do you think they would feel about, you know, the stuff that you've shared? Do you think they'd be like, you know, Matt, why are you sharing that? Or just curious,
I think so. I think that I've probably said more than they would want. They're very much heads down and just into their work, because anytime you say something before it happens, it can change the day before it comes out. So so I could say something now, and this is something that we talked about then, and then the whole product could change once they take that feedback and go back and do it again. So yeah, they'd probably think I'm an idiot, but well, what do you do?
I think you've spoken very highly of them, and I don't think you're holding them to any sort of product deadline or anything like that. So, hope you're fine.
Yeah, it'll be fine.
Chris, Roy, you guys look like you're about to say something. No? All right, let's wrap it
I've
there.
got more questions, but let's wrap.
What is going on? This there's a bunch of no's, and then all of a sudden there's stuff that everyone has to say. I am rapping. Ladies and gentlemen, thank you all so much for watching. We're going to take this into the SoFi after hours show. If you guys want access to that, you can hit the join button down below. You got to make sure that you're subscribed, though, or else that button will not appear. Or I think Tevis
I actually have a question. I'm kidding. I'm kidding. Thanks everybody for watching. See ya.
Tanner.